Hello, everyone. My name is Manal Azim, and I have recently joined Valeem as an ONA level accounting tutor. So, just to start off with a little bit about myself, I completed the ACCA Association of Chartered Certified Accountants in 2018 from the Middle East. I was also awarded the ACCA Global Prize Winner Award as I was able to score the highest marks worldwide in my financial management exam. I then moved on to completing my Bachelor's of Science honors in applied accounting from the Oxford Brookes University. After this, I worked in the insurance sector for a short amount of time, but I quickly then moved on to teaching at a Canadian company, Paper Academy, where I was an accounting and mathematics tutor. And now I have recently joined Valeem. So, the topic that we will be talking about today is bank reconciliations. So let's start off with the agenda first of all. After we move on with the introduction of what bank reconciliations are and why do we prepare them, we will be talking about some of the terminology, which is quite important for the purpose of this topic. We also need to talk about the reasons of why the cash book and the bank statement might be showing different values. We will then move on to looking at a logical approach of preparing a bank reconciliation statement. And then in the end, we will look at a question so that we can make sure that all of the theoretical aspects that we have studied, we are able to apply them in practice. So, what are bank reconciliations and why do we prepare them? Now, as a business, we would have a cash book where we would be recording all of the cash coming into the business and all of the cash going out of the business. And at the same time, we would have transactions going on in our bank account. Now, at the end of every month or at the end of every year, we would want to compare the balance which is being shown in our cash book and the balance in our bank statement to make sure that they match. Now, very often in the practical world, this is not the case, and bank reconciliations are then prepared to investigate all of the differences. And the reason why we do this is to make sure that all of the transactions which are happening within the bank are the ones that we are aware of, we have authorized, we have reviewed, and also to avoid any errors, omissions, or frauds within the company. So if we move on to talking about terminology, now balance on the bank statement. Cash for us is an asset. So obviously on our cash book, it will appear as a debit balance. However, if you see a bank statement and it says that we have $5,000 of a credit balance, does this mean that we have an overdraft? No. Because if we think about it technically, the amount of money that we have in our bank account is basically something that is in the bank, but it belongs to us. So technically, the bank owes us this money and we can withdraw it from our bank account at any time. So for them, this amount of cash is a liability, which is why they will always treat it as a credit balance in the bank statement. So a balance on my cash book of 5,000, a debit balance will appear as 5,000 credit balance on the bank statement. Checks and drawer of check is pretty straightforward. A check is a way of paying money. I'm pretty sure all of us would be using this in our day-to-day lives. And a drawer of the check is the person who writes the check. Unpresented checks, this is a situation where, let's say, that we have we want to make a payment to a supplier. So we write down a check of $100 and we send it off to the supplier. Now, as soon as I write this check and I send it off to my supplier, in my cash book, I will enter a credit entry of $100 as cash going out of my cash book. However, this check might actually take a few days to reach my supplier. The supplier might have it lying around in their office for another few days, and then their bank might take another few days to process the check and for the money to finally travel out of my bank account and into my supplier's bank account. Now, the difference between these two transactions happening in this time period, if I was to extract my bank statement, I would see that the $100 is not appearing in my bank statement, but it is being shown as paid out from my cash book. So this is a situation which is called an unpresented check, where we have sent out the check, but the supplier has not yet presented their check to the bank and the money has not yet actually traveled out of my bank account. Something very similar to this, but the exact opposite is deposits not yet credited. So this is situation when, let's say, a customer has made a payment to us for $100. As soon as I receive the check in my office and I see it, so I enter it into my cash book, debit $100, I have received this amount of cash. But the check might be sent to the bank account maybe the week after. The bank might take a few days to process it. So, and then the bank might process the check. They would contact the customer's bank. And maybe after a week or so, the money would actually be coming into my bank account. So if a bank reconciliation statement was prepared within this week, then this 100 would be a discrepancy because I would have noted it down in my cash book that I have received this check, but it's still a few days until I'm actually going to receive the material money into my bank account. So these two situations are basically called timing differences, where a timing issue causes a difference between my cash book and my bank statement. Dishonored checks. This is basically a situation where the bank refuses to pay the amount of the check to the payee. So let's say a customer paid us, sent us a check for $100, and I wrote it down in my cash book that I received this check for $100. And I will eventually receive the money, but when I send the check to my bank for them to process it, they let me know that maybe there is a fault in the customer's bank account or the customer has gone bankrupt and that we cannot recover the money. So basically the check has been dishonored, the check has no value. A credit transfer, we also use this very much in our day-to-day lives. It is basically a direct payment of money from one bank account to another. So it's like an online bank transfer, which we also do on a personal basis. Standing orders, a very good example of standing orders is rental payments. Now, let's say that I run a business and I have to rent out an office. Now, every month I have to pay $1,000 to the rental company. Now, instead of at the end of every month, I write down a check, I get it reviewed, I get it authorized, and I send it to my bank account, and then the rental company, and then all of the processing would take a lot of time. I can instruct my bank that at the end of every month, please automatically transfer $1,000 to the rental company. So it is an automatic transfer of a fixed amount out of my bank at regular intervals. This process or this arrangement is called a standing order. Similar to this is direct debits. An example of this is a telephone bill. I would instruct my bank to automatically transfer the amount of my telephone bill to the telephone company. The only difference of this from the standing orders is that the amount every month might be different because the telephone bills might be higher one month, they might be lower the next month. So direct debits is also very similar to the standing orders, but it is an automatic transfer of not a fixed amount, but any amount of funds from our bank at regular intervals of variable amounts. So what are the most common reasons for differences between my cash book and my bank statement? One of the most common errors is a cash book error, a numerical mistake. Maybe in my cash book, I intended to write $1,000 received. However, accidentally, I entered $100 only. So this will obviously create a discrepancy from my bank statement. Cash book omissions, maybe we missed out a check completely, so we have omitted an item from our cash book. Something rare is when a bank could be making a mistake. And if we do spot this, then we have to communicate this to the bank so that they can make the correction in the next month's bank statement. And timing differences is what we discovered, is what we discussed earlier, the unpresented checks and the lodgements not yet credited, where the time from when we actually receive or send the check to the time when the money actually travels in or out of our bank account has a large difference, maybe a week or so. And this is very common in the UK because postage delays are very common in the UK, where companies and banks and customers and suppliers tend to use post to send their checks to the other party. And in the exam, our role is to explain why the values on the cash book and the bank statement are different. And these are the most common reasons that we will be explaining in the exam questions. So, what is then a logical approach to preparing a bank reconciliation statement? First of all, we have our cash book and our bank statement. We compare all of the items on our cash book to our bank statement, and all of the items which are matching, we will tick them off. The next thing that we are supposed to do is to identify the unmatched items and identify if these are errors or if these are timing differences. Now, if these are errors in the cash book, we will rectify them using a T account. We will be looking at a question just shortly. So we will use a T account and use the appropriate debit or credit entries to rectify those errors. If there's are errors in the bank statement, we will have to contact our bank and let them know that they will need to fix the error in the next month's bank statement. And if there is a timing difference and the bank mistakes, we will have to be preparing a bank reconciliation statement. We have a pro forma here. We will have to follow this approach to make sure that the balance on the bank reconciliation statement that we prepare, the final balance has to match our corrected cash book account balance to make sure that there has not been a fraud or anything missing in the company. The pro forma of the bank reconciliation statement basically follows these steps. It starts off with the balance per the bank statement. Then we will have to add or deduct any bank errors depending on what the mistake is. If the bank is accidentally given us an extra 100, we will have to deduct that from the balance by the bank statement, and vice versa if they have accidentally reduced an amount. Then lodgements not yet credited have to be added to our bank statement balance. The reason for this is that basically this lodgements not yet credited are checks which we have received. So we have written them down in our cash book, but our bank has not yet processed it. So after a few days, the bank account will be receiving this money eventually when the bank processes this check and receives the cash from the customers. So eventually this is money coming into our bank account. At the same time, unpresented checks, this is a situation where we have wrote down in our cash book that I'm sending this check off to the supplier, and this money will eventually travel out of my bank account when my supplier processes the check that I sent them. So that's why this amount needs to be deducted on our bank statement balance, and the resulting balance as per the corrected cash account should match the cash account balance to make sure that we have done everything correctly. So let's just look at a bank reconciliation example to make sure that we understand all of the theoretical aspects. Let's read it first. At 31st of December 2007, the balance on the cash account was 11,820 debit. So this means that we had a positive cash balance of 11,820 in as per our cash book. But the balance appearing on the bank statement was 15,000 credit. Now, the 15,000 credit, like we discussed before, means that the bank is saying that we have a positive 15,000 balance in our bank account. Why? Because it's a credit balance, and this is the money that technically the bank owes to us. So it's like a liability for the bank, which is why they state it as a credit balance on the bank statement. So now we can clearly see that there is a difference between the balance on our cash book and our bank statement, and the reasons for the differences have been given to us. Now, what we need to identify is, using these differences, we need to identify what the correct cash book balance is and what the correct bank statement balance needs to be. So first of all, we have bank charges of 20. Now, bank charges simply are something which the bank charges us, that's a nominal fee for the services which the banks provide us. For example, processing our checks, standing orders, direct debits, all of these things the bank can charge us for this. So the simple treatment for bank charges of $20 is that we basically have to write this off from our cash book account. So it will be a credit entry out of our cash book, because this is something which has been deducted from our bank account automatically. The bank has automatically taken $20 from our bank account as services that they're providing to us. A payment of 1,200 had been entered in the cash account as 2,100. This is a situation of a cash book error. Instead of entering a payment of 1,200, we accidentally entered a payment of 2,100. A check for 200 had been dishonored. This is also something that we discussed before. A dishonored check is something that we thought we would receive. However, the customer has defaulted on their payment and the bank has told us that they cannot process this check. So now we need to remove this from our cash book. Then number 4 and 5, we had unpresented checks and we have lodgements not yet credited. These are timing differences and we will look at them shortly. So the first amount then is the bank charges of $20. So if we start off with our cash book balance of 11,820, 11,820 was the balance at 31st of December 2007. A debit balance 11,820. This is what we need to start with. Then the first adjustment that we were required to make was bank charges of $20. So the banks has already charged this from our bank account. So the simple treatment of this is to also charge it in our cash book. So this is a credit balance of $20 bank charges. We are entering it into the cash T account. The next thing that was 1,200 had been entered in the cash account is 2,100. So originally, a payment had been entered for 2,100. However, now we need to reduce this payment to 1,200. So the difference between 2,100 and 1,200 is 900. To make this 2,100 go back to 1,200, we need to reduce this by 900. And the way to reduce a credit balance is to enter a debit balance. So a debit balance of 900 will be entered here as an incorrect payment. The next thing was a check for 200 had been dishonored. So this is something that we thought we would receive. We entered it into our cash book, but the bank has told us that no, we will not be receiving this. They cannot get this money from the customer. So now we need to remove this from our cash book. And the simple thing of how we do this is to enter a credit entry in our cash T account. So we started off with 11,820. We added 900, deduct 20, deduct 200, and the answer is 12,500. This is the balance as per the corrected cash account. And if we do everything correctly, then the bank statement balance should match the 12,500 of the corrected cash balance account. The unpresented checks and the lodgements not yet credited, these do not go in my cash book like I told you before. These will go in our bank statement because both of these things are something that we have already entered into our cash book. And this is something which will eventually be received or eventually be paid out of my bank account. So this will only affect my bank reconciliation statement. So let's move on to the bank reconciliation statement, keeping in mind that the balance appearing on the bank statement was 15,000 credit, which means it's a positive balance. So let's move on to the bank reconciliation statement working. So balance per the bank statement was 15,000, right? Were there any bank errors in the question? No, so we leave this blank. We still have 15,000. The next part is the lodgements not yet credited of 4,000. Now, like I said before, these will have to be added in my bank statement balance because this is money that we will eventually receive from our customers once our bank processes the check. Similarly, the unpresented checks of 6,500 have to be deducted from my bank statement balance because these are amounts which will be paid out of my bank account eventually when the supplier whom I send the check will get their check processed. So 15,000, add 4,000, subtract 6,500, we get $12,500. And like I said before, because we've done everything correctly, this amount of 12,500 on my bank reconciliation statement matches the 12,500 on my corrected cash balance account, which shows us that we have been successfully able to identify all of the discrepancies. We have been able to reconcile our cash account balance with my bank statement balance and make sure that there are no other errors, no other mistakes, no fraud within the company. And anything which is still left off is the timing differences, which will eventually be fixed once the money actually travels out and travels into my bank account. So this was a short overview on how bank reconciliations work. Hopefully you had a good time learning with me, and I was able to clear this concept of bank reconciliations because this is an important part of the O-level syllabus as well as the A-level accounting syllabus. I'm looking forward to teaching you all at Valeem, and have a good day. Thank you.